Hello traders, and thanks for joining us for a new edition. Market evaluation may get rather overwhelming, complex, and can also take up a significant amount of time. If you're unaware, what essential elements you should spot on your pricing chart. In this video, we'll provide a brief rundown to help simplify it for you. As well as, we'll cover both fundamental and advanced ICT concepts regarding the crucial factors and components you should recognize and plot them on your chart. So traders, if that's something that sparks your interest, be sure to hit the like button to support the content and subscribe to the channel if you're new here. Catch you right after the intro. Glad to have you back, traders. Let's dive in. So, what are the crucial elements we need to spot on the price chart? First, we need to locate the latest zones where liquidity has been swept. Second, identify resting areas of buy-side or sell-side liquidity. Third, highlight any fair value gaps present. Fourth, pinpoint order blocks that are near the current market level. Fifth, recognize zones of premium and discount. Sixth, observe the overall market structure. Let's begin with key factor number 1, spotting the most recent liquidity sweep zones. To do this, we need to analyze the chart and locate areas where liquidity was recently taken out. If you're unclear about what liquidity means or where it typically forms, be sure to check out our liquidity and inducement video linked in the description below. Now, looking at this example, we notice a significant low where price has broken through, sweeping the liquidity pool beneath it, triggered by this extended wick, which likely represents a cluster of stop orders. So, we mark this liquidity sweep zone directly on our chart. The second key factor involves spotting liquidity resting zones. In other words, we need to locate areas on the chart where liquidity is likely sitting, as price may attempt to reach and absorb it. In this example, you can see a strong bearish impulse clearing sell-side liquidity, which signals that we now need to identify the buy-side liquidity levels present on the chart. Here, we can see a buy-side liquidity zone at this point. Additionally, there's a solid liquidity pool sitting just above this previous high. Moving forward, another area of buy-side liquidity is visible here, and a strong liquidity zone exists right above this swing high. With all these resting liquidity zones now marked, you'll notice that price has already cleared the sell-side liquidity from the market. Based on this, we can expect price to potentially move upward, targeting the internal buy-side liquidity areas we've marked on the chart. The following key element we're examining is fair value gaps. To gain deeper insight into FVGs, before diving into any definitions, it's important to first understand what inefficiency means. So traders, what exactly is inefficiency? Inefficiency happens when there's a mismatch between buying and selling pressure in the market, creating an imbalance that the market later seeks to correct. Simply put, when there's a visible gap between candlesticks, we refer to it as an inefficiency. Now let's break down how to spot inefficiency in the market. On the left side, you'll notice a visible gap between the candlesticks. This suggests that price may return to revisit that empty zone to fill the gap. This scenario is what we refer to as inefficiency. On the other hand, if you look at the candles on the right side, there's no gap present, meaning no inefficiency exists in that section. Let's now shift our focus to fair value gaps. What exactly is a fair value gap, and how do we spot it? Fair value gaps are areas formed due to inefficiencies in the market, typically found in regions with minimal trading activity, where price moves strongly in just one direction. Fair value gaps play a crucial role in price action trading, marking zones where a high volume of orders caused market inefficiency. These gaps signal fresh trading opportunities, particularly when aligned with order blocks. Since FVGs often attract price to return and fill the imbalance due to the presence of resting orders, they can be strategically used as targets for trade entries. Now let's look at how to pinpoint a fair value gap. FVGs are typically formed within a 3-candle structure and are often represented by a prominent candle whose body isn't fully overlapped by the wicks of the candles on either side. This creates a gap, the fair value zone, between the wicks, which is marked over the candle body. In this example, a downward price move generates a fair value gap, or liquidity gap, due to insufficient buying activity that fails to counter the sharp decline. To accurately identify an FVG, focus only on the impulsive candle, either upward or downward, along with the candles immediately before and after it. Nothing beyond those contributes to the gap. These liquidity pockets are significant, often serving as key entry zones, because markets are attracted to liquidity. When price is gearing for a downward move, it typically targets liquidity areas above. That's why FVGs are prime zones where price may temporarily rise, test the gap, and then resume a stronger bearish move. Let's dive into the chart and start marking the fair value gaps. The current price is located here, so we'll focus on the zones above this level to find any existing FVGs. Here's a fair value gap right at this level, another one can be found here, and this entire area also qualifies as a fair value gap. That gives us 3 FVGs above the current price, all of which the market might move toward. Additionally, there's a small fair value gap over here, and another one that can be identified just at this point. It's always a good practice to highlight FVGs close to the market's present position, because leaving them unmarked can lead to avoidable losses in your strategy. Now, let's proceed to the next important factor to be marked on the chart, our fourth key element, which involves identifying order blocks situated near the current market level. Let's begin with a precise definition of order blocks. Order blocks are highly significant, refined zones of supply and demand that contain a substantial concentration of buy or sell orders. When price approaches these zones, it has the potential to reverse its direction. Now let's explore how to recognize an order block on a candlestick chart. In a bullish context, the final bearish candle before a strong upward movement is considered an order block, or it could be the initial weak candle preceding a sharp rally. However, for an order block to be valid, a recent break in market structure must occur. This same principle is applicable in bearish setups. On this price chart, with a closer look, we can clearly identify this order block from which price reacted and reversed. Additionally, we have another ideal order block positioned close to the fair value gap and the liquidity resting area. Looking more closely at the price chart here, we can clearly observe this order block where the price reacted and reversed from that level. Additionally, there's a textbook order block positioned right beside the fair value gap and the liquidity resting zone. Now, let's transition to the next important element. The upcoming key factor involves recognizing premium and discount zones. So, what exactly are premium and discount zones? To increase the chances of high probability setups, we need price to be located in optimal zones that boost our trade accuracy. We apply the Fibonacci tool to determine whether the price is sitting in the premium or discount area. Our strategy is to enter buys in the discount zone and execute sells in the premium zone. We can also utilize premium and discount zones to locate valid order blocks and fair value gaps for trading purposes. For instance, in a bullish market, focusing on bullish order blocks positioned in the discount zone can enhance our trading plan and help minimize possible losses. Now, how do we accurately mark the premium and discount regions on the chart? To determine whether the price is in a premium or discount zone, we use the Fibonacci tool by connecting the swing high and swing low of the price movement. The area below the 0.5 Fibonacci level is referred to as the discount zone, while the area above the equilibrium line is known as the premium zone. These zones are considered reliable only when an impulsive move breaks the recent market structure. In a bearish scenario, the Fibonacci tool is drawn from the beginning of the impulsive move to its end. The same principle applies in a bullish scenario. Now, let's add the premium and discount zones to our chart. As you can see, we have a clear bearish impulsive move. To draw the premium and discount zones, we apply the Fibonacci tool from the high of this move to its lowest point. Then, we draw a line at the 50% level of the Fibonacci range to establish our equilibrium. The zone below this equilibrium line is referred to as the discount zone, and the area above it is known as the premium zone. When price is in the discount zone, meaning it's below the equilibrium level, it's considered a favorable area for long, buy positions. Conversely, when price is in the premium zone, it's viewed as expensive, making it more suitable for short, sell positions. Long trades should generally be avoided when price is above the equilibrium, in the premium zone. Let's now move on to the final key factor, which is analyzing the general market structure. This means identifying the overall market direction and the structural patterns it forms over time. As you can see on the chart, price was clearly in a strong uptrend. However, we're now witnessing a market structure shift. Price failed to form a new higher high and instead broke below the previous higher low. This marks a change of character, CHOCH, confirming a potential shift in market direction. Also, take note of the sell side liquidity that was resting below the structure. It's been swept by this move, which adds more confirmation to the shift. Now, although the overall market direction has flipped bearish, there's still a high probability that price will push higher to sweep buy-side liquidity before continuing downward. This aligns with the concept that the market often grabs liquidity before committing to a directional move. Given the structure change, we can confidently say the market is now in a downtrend. What we want to see next is price rising above the 0.5 Fibonacci level, entering the premium zone, to give us a high probability setup for entering short positions. So, at this stage, we've marked up all the key factors on the price chart: liquidity zones, fair value gaps, order blocks, premium, discount zones, and market structure. With everything now mapped out, we're fully equipped to analyze and execute with precision. You can clearly see that market structure has shifted on the 4-hour time frame, indicating a likely move toward bearish price action. Now, when we zoom into the lower time frames, we can already spot that sell-side liquidity has been swept. During this liquidity sweep, the market left behind 3 distinct fair value gaps. So, the key question is, which one of these is the most significant? Out of the 3, this specific fair value gap stands out. Why? First, it's located within the premium zone, making it a high probability area for price reversal. Second, there's a strong liquidity resting zone sitting just below it, which further validates its importance. Since the market has already taken out the sell-side liquidity, it's reasonable to expect price to push higher, possibly to sweep the buy-side liquidity, and continue moving up into this fair value gap zone. Once that gap is filled, there's a strong chance the market may reverse and continue its bearish trend. This is where we can start using ICT trading strategies and patterns to look for short entries around this fair value gap. It's a textbook example of smart money concepts in action. In the upcoming episodes, we'll dive deeper and optimize a range of ICT-based trading strategies and setups that will not only support your system but could seriously boost your win rate, so stay tuned. That's it for today, traders. If you enjoyed this breakdown and want more content like this every week, make sure to hit that subscribe button, turn on the notification bell, and drop a comment below. Let us know your thoughts, questions, and what topics you want us to cover next. Thanks for watching, and we'll catch you in the next episode. Stay smart, trade smart. Rising market.